Happy Friday. Welcome back to the Talk with Kiet show where we connect people, ideas, and capital to help make a difference. Now, I am on now live with Mac Thompson. Mac is the founder and CEO of White Clay. Mac is an amazing entrepreneur. Mac and I today will talk about his career journey as well as his entrepreneurship journey, but most importantly, the future of commercial banking. Mac, welcome to the show.
Welcome, Kit. Good morning. We're gonna have some fun.
Yeah, so Mac, usually what we start with is origin story
Yep.
because that gives a lot of context to people. So, and I want to start with what is Mac's origin story?
White Clay's origin story, Mac's origin story.
Let's start with Mac.
Okay. Well, I grew up in Western Kentucky, so land between the lakes area. If anyone's familiar with it, I grew up. The entire county had about 6,000 people in it. 2 stoplights. That's where I grew up. And great parts about that, some bad parts about that, but it is still part of where I grew up. One weird part, though, was we would travel. So when my family was very affluent when I was growing up, and we would go to Europe for the summer. We would spend lots of time in Vero Beach. They moved to Vero Beach when I was in college. But it was, so I grew up there. Started off, went to school at a liberal school called Transylvania University in Lexington, Kentucky. Didn't plan on going into banking. The summer after I graduated, I interned for a congressman from Kentucky. Turned out to be on the banking committee in the House. Didn't even care about that then. But I came out of college in the recession of 2092. And one of the hardest parts about that is I applied for over 250 jobs. I got 4 interviews. I got turned down by a pet clinic. That is a bookkeeping job. I wish I had kept a letter because it's one of those things that Sheeple Pet Clinic in Lexington, Kentucky. But I eventually basically went to the unemployment office is where I did. And I waited in line. If you ever want a humbling experience in your life, go wait in the line at the unemployment office. So about 2 hours, this giant long list of people. It was a pretty bad recession in Lexington. My wife was still in school. That's why I was staying there. Wasn't my wife then, but we would become married. And through that unemployment agency, so I got my first job at Bank One Lexington. I was the dude in accounting that punched the GL tickets in. So they would drop off. I don't know, guys, anyone old enough to remember GL tickets? They were paper, red, and black tickets that people would drop off. I keyed them in. That was my job. But it was a job. And strangely, it actually really helped me because I learned where how the cash flows and all the entries went throughout the entire bank. So it was an interesting first experience, but wasn't great at it. I don't know if you want this much detail, but wasn't great at it. I got the tickets backwards all the time. They were going to fire me, and the CFO of the bank said, "You're pretty smart. You know some things about computers." I'd been really into computers when I was younger. Come back in 2 weeks and tell me what you can do here that can justify your salary, give the bank good return. So I came back, got into, this is how I got into banking, but we printed off millions and millions of pages of green bar. So what I did was I actually went in, got up at 3 o'clock every morning, went down to the print shop and mapped out throughout the entire bank where all those millions of pages went. Figured out we didn't need about 4 million of those pages. And that was my first entrepreneurial thing inside of a bank. And then I just did projects and projects and projects. Through the banks, I was at Bank One. Was a problem solver. 7 years later, from that entry-level position, I was CFO of marketing for our consumer banking world at Bank One up in Wilmington. So worked my butt off. Had a lot of great people to help me along the way. But that's how I got into banking. I can go into other parts of it if you like, but from there, I did a .com in the middle in Europe, and then I went to work for Bank of America for a while, and then I started White Clay.
Now, zoom in a bit because when you were 22, your parents filed for bankruptcy. Right?
Yep.
Talk about that experience and how that influenced your decision making.
It was crazy. One bad thing about, there's lots of bad things, lots of good things. Probably one of the best things that ever happened in my life, strangely, in retrospect. My dad had been a public figure. He had been Secretary of Finance for the state of Kentucky, so he was into politics a bit. And so when they declared bankruptcy, it was how I found out was the CFO that I just mentioned walked over, and there's the state paper, the little Courier Journal, had a full page ad some people had taken out declaring my parents declared bankruptcy in Florida. So it was very public, which is kind of odd. Most people don't have to experience it that way. But what it did was it took, entrepreneurial wise, it changed me fundamentally. It took me from an entitlement kind of mentality because I'd grown up very wealthy. I mean, we were summering in Nice and Monte Carlo and stuff, things like that. To this is now on me. And that realization was about an hour-long process. It took me about a year to completely process all of that. But from that point forward, I got much more driven about what is it I want, what is I'm going to do, and it's on me 100%. There's no calling your parents. There's no any of that anymore. There's no, all those things. So it was tough emotionally, but actually the hardest part of it is more inwardly focusing on what is it, the realization that everything I'm going to do from this point forward is on me. And that was a enlightening, liberating, terrifying, and all those kinds of things experience. But like I said, the one weird part about it is that was all done in the public eye. So it was strange.
Well, what's interesting is, and we touched on this in prior shows, people talk about gratitude. They always talk about the good stuff that happened in their life and not the bad stuff. But sometimes it's those lessons learned in life situation you're in that's actually helped make you who you are in a way, right?
This goes back to basketball. Basketball, I grew about, 4 or 6 inches one year. So I went from being a pretty good basketball player to a much taller basketball player, but very uncoordinated. And I had a good work ethic. I worked really hard. But this is another one of these bad. I didn't become recoordinated until I was probably out of college, right? In college at some point. But what it taught me was, when I left that, I was never going to be really good at it. But what it taught me was, if there is something I am good at, and I will use this same work ethic, I can do anything I want. And that failure, we were awful, but I didn't play, but we weren't a great basketball team. Strangely, the county, this is 30 years later, they won the state championship last year. Travis Perry from UK was on that team. He was all-time leading scorer for state of Kentucky in high school basketball. But we were not that team. But that failure is an awesome learning experience, because it will give you the motivation to get through basically anything you need to get through when you need to. A lot of people haven't experienced failure. There's all kinds of challenges you have. Those challenges, though, can be the best learning experiences, because it prepares you for when bad times happen. And in everyone's life, bad times are going to happen. And it gives you the knowledge that you can get through this. And so crisis, anytime I do very well at crisis situations because I've been through a lot of them, and that's good. It's great life experience. People should. Entrepreneurs, when I say this, entrepreneurs know this. You're going to fail often, and you need to probably fail more, faster, and learn from it. Fail fast, learn from it, and do something else. And I think in entrepreneurship, you live that, right? Everyone's worried. Like when I was in commercial banking, most people were worried about making a mistake. But in entrepreneurship, you make mistakes every day. It's just a question of how fast can you learn, how fast can you adapt, and how fast can you move forward.
No, that's right. And standing back up, no matter how bad it looks, right?
You have to be fine. And if you've never been through that, then you get smacked in the face with that at 35, and you have a family, and that's a really hard experience. But if you have to experience that when you're, younger and going through hard, you get used to it. It's a learned skill, but you know how to do it. And unfortunately, the first time you do it, you never choose to do it. You're kind of forced into it.
It's the Dana White saying, you can plan all you want until you're punched in the face.
Yeah, for sure. And that's okay.
Yeah. So talk about White Clay, right? So you started White Clay 18 and a half years ago.
Yep.
Right. To me, the fair was first attempt in learning. right? And you never really fail until you really give up. And so you've navigated White Clay for 18 and a half years.
Oh yeah.
Talk about the original story of White Clay and how you pivoted, you know, like
Um,
from the first 10 years.
well, we don't usually talk about this, but between Bank One and Bank of America, I was asked by a friend of mine, Sanjeev Das. I don't know if but Sanjeev, he's been in lots of roles, various different banks. Great guy, wonderful, great family. He had gone to a .com in Europe, and I met him for lunch at the DuPont Hotel in Wilmington, Delaware, for brunch. And he said, "I need you to come to Europe. I need you to help us build out the business case and help raise the money." Someone else, Wendy, I can't remember her last name, was actually CFO. She raised the money. I just helped. But he goes, the real trick is I can't give you a contract. I can't tell you how we're going to pay you, but I need you on a plane to Luxembourg in 3 hours. And I lived an hour and a half from there. So I called my wife, had her pack a bag, grabbed my laptop bag, and meet me at the airport. And I went and I came home about 4 months later. I was between Jai and just left Bank One. He had been at Bank One as well. But White Clay came from, I lived on White Clay State Park. And she had to come up. We came up with a name in that hour and a half of something I needed because I didn't know how to do this. So he says, just form a consulting company, we'll do that. So that's where initially it came from. All that aside, I learned a whole bunch of things on that about investors and other kinds of fun things. But what I learned more than anything else was how I had been working for large companies and banks for a long time. I didn't understand things like cash flow. So about a year later, when that was over, Bank of America recruited me back. I made a list of all the things I'd have to learn how to do before I became an entrepreneur again, because I wasn't prepared. And it was, cash flow was one of the things that's so foreign to me because, if you work for a bank, checks come in every 2 weeks. They have tons of cash. There's a room downstairs with lots of, just never worry about cash. Yeah. If you're an entrepreneur, you worry about cash every single day, especially if you go through, well, all of them do, regardless. So I made my list. When I went to B of A, I essentially tried to pick jobs that knocked things off that list so I could get experience around it. Well, how I started White Clay, just transitioned that. That's originally where the name came from. We had built lots of tools and technologies for very big banks, and they have really advanced capabilities that the regionals and small banks, small regionals, and communities didn't have. So the original reason why we started was we were going to provide these similar kinds of tools to regional and community banks. We wanted to level the playing field because I can't even imagine where they are now. There are things that small banks, like community banks and regionals, don't have now that we had 20 years ago. And we built a lot of those things. Now, so where they are now is got to be insane. But that's what we did. That's where we started out. And we spent the first 10 years really custom software, custom consulting, working for people we used to work with at the banks. I had a lot of success. It was doing great. A nonprofit organization called Endeavor, which is a scale-up organization started by entrepreneurs from around the world, had just decided to come back to the United States and reach some markets that had maybe not had the entrepreneurial scale-up that they could have. One of those markets was Louisville. And before they started the office, me and another gentleman from Louisville and Jackson Andrews went to just up north from near Connecticut to a conference with all these worldwide entrepreneurs. And they're all about scale-up. And spent 2 days with them. Got so excited about scaling up and what that meant that when I got back in Sunday night, Monday morning, met with the team and just told them we are blowing up the entire organization. We're going to rebuild everything and we're going to build a scale up. Didn't have a plan for it. Didn't know what it was. I just knew my soul. This is what we were going to do. Now, if I had known in my time how much cash we were going to burn doing that, I might have thought something different. But that was the pivot point when we started scaling. That's why we started, and then that's why when we pivoted, it took us about 2.5 years.
But that must be nerve-wracking, right? To go from a profitable cash flowing business, where you're bringing home the bacon and say, you know what, I'm going to kill this whole thing, rebuild it, and now here's where we're going. And it took 2.5 years. Like, talk about that whole experience. Like let people know the grittiness you have to go through.
We're in the business, and we're my partner and I, we're making I'm in seven figure. I mean, we're doing great, right?
Yeah.
I mean, we are cranking along. It's busy. It's whatever. And then we get into the scale up and the build out. Different. Both are entrepreneurial. They're just different kinds of entrepreneurial. We started burning cash greatly. I mean, I up to this. At one point we were like, how much money is in the bank? We got 35 employees at the time. I think we had $6,000. Line of credits peaked, and I'm writing checks every week to essentially make payroll, not getting paid. And it is awesome. It is terrifying, but it's extremely fulfilling when you get through it. I don't know if lots of people want to experience that, but it's probably everyone's probably got a cash flow story at some point where it's margin call, gentlemen. It's from trading places. You got to figure out what you're going to do.
Yeah.
But we pivoted when I was 45. That's when we started it. It was it was super fulfilling, super challenging. It's what I wanted to do, though. If you aren't into that kind of environment, it is a very tough thing to live through. But it's an awesome experience. One of our largest clients, one of our clients, turned out it's one of our larger clients, and had a requirement. We were trying to close them. It was really a big deal for us. And they said, okay, you guys' processing time is this. I don't even remember what it was. We need you to process 4 times as much volume. Demonstrate to us you can process 4 times as much volume in about half the time, because we're worried about scalability. You have 2 weeks. So we had to go back, re-engineer the entire processing engine around this thing, where it was 8 times faster in 2 weeks. We did it. Is that rational? Was that something that you would say, here's my plan and what we're going to do? No, you just go out and invent it. And that's the fun part of it, right? You get put with apparently impossible questions. I don't know if they knew what we had to do that, but we did. And that is, if you don't, I really love that experience. And I think a lot of entrepreneurs like that kind of experience. And that's part of the joy. You get to do impossible things. And once you've done that a few times, what's impossible is redefined.
No, exactly. But I think you raise a good point. That is, sometimes over planning may not be a good thing, right? Because it's being able to navigate the unknowns and really being flexible in your thinking.
Yeah, we call it A to B. If you're going to go to A to B, the trick isn't coming up with a giant plan of how you're going to go from A to B. The trick is figuring out what the hell B is, and maybe where A is. And so you have to iterate, and you have to get really good at fast iterations. That the thing I just described, we didn't come up with one way to do it. We iterated hundreds of times in 2 weeks, and we figured it out. But the last one worked. The other 99 didn't. But the key is failing the other 99 times to figure out the one that does, and not be worried about the failure and getting hung up on that. I think too many folks want to make that journey from A to B once. The reality is, if you're going to do something awesome, you're going to have to do it a whole bunch faster than that and fail a bunch more, because you're not going to get radically different changes unless you change something radically, and that requires failure. Because if you can do it in the first shot, congratulations. I don't know how you do that, but good luck. Maybe you're super lucky. I don't know. But that's the trick, is go A to B as many times as you can, because you'll learn each journey. And then you take those learnings, you adapt, and then you eventually get there and solve the problem. Most every time we've ever, and this is my entire banking career, I guess, is when put with those really important challenges, the first solution's never been the one that worked. It's always been it's something we learned, iterate, and then you eventually get there. Usually it's about, your assumptions around defining what A was and what B was wrong. And that's actually what created the situation. The learning of the journey is let you figure out what those should be. I always like doing that. We still do it. We call it A to B.
Yeah. No, look, that's the great way of putting it, right? Because there's a study where they have 2 control groups. The first control group, it was about making pottery. They say Your goal within the next 5 hours is to make as many pottery as you can. Don't worry about it. The second control group was, I want you to make the perfect pottery. You only get one chance.
Yeah.
Right. And the end of it, what they discovered was the skill set that was built was much better in the first instance than the second. Right. And so a lot of times we're always striving for perfection because we go up like, you got to be perfect. There's no such thing as perfection. Right. It's about taking action. Perfection is a sign for procrastination. Right. Like the look, even the show that started, when I first say, well, I'm going to do a show, I'm like, how am I going to do it?
Yeah.
Do I need to do recording perfect? No, I'm just going to do it. And we did it. Look, we've been doing this for the last 2.5 years, right? And so, and that's key. So that's a great nugget, is from A to B. So thank you for that.
Yeah, you're welcome. It's fun. We do it all the time.
And so let's pivot a bit. Look, a lot of community banks, a lot of regional banks use your platform to run their banking business. But then the question I have, and I'm sure everyone's curious, is what we've seen over the last 2 years on just the world of commercial banking.
Yep.
Right. Like is that business here to stay? Like with Silicon Valley Bank and what's going on? Like what are you seeing?
For about 15 years, so since 2008-9, right? How banks generally grew was, let's just think about the environment. Interest rate, Fed funds rate was near zero. Liquidity was readily available. Capital's costs had come down a bit. Losses, we haven't seen significant losses. So the world of banking for about 15 years was grow loans, add some fees, declare victory, and move on. It wasn't really banking as so much as it was a loan origination and get some fees. Generally, banking, in starting about 2 years ago, when it came to a crisis point, mini crisis point, in March of 2023, was you actually had to start thinking about both sides of your balance sheet. You had to get back to banking, that we have a liability side, we have an asset side, and we need to, that's what banking really is managing and optimizing both of those and taking care of both constituents, sometimes they're the same, but balancing that. And once the cost of funds started going up, liquidity became more, I don't know if more scarce because there's a lot, but more competitive, but it also became more costly. So you had to understand your cost of deposits, how you were sourcing, how you were funding, and you really need to come up with balance sheet strategies that were right for your bank. March 23 is where it wasn't really banking in general. I think March of 23, you got some banks. Silicon Valley was an example where they didn't have a balance sheet strategy. They put a large amount of their deposits into treasuries, more long-term than short-term, and they got caught in the valuation of those, which then created a liquidity crisis, which then they quickly went under. And the assets had to be bought up by people. I oversimplified that. But some of the other ones were more runs of that nature where people were looking at balance sheets. But most of the banks hadn't had to think about balance sheets. So when deposit pricing started going up, most banks didn't have anyone on staff that had ever been around the last time we had to price deposits, which was 2005. So there wasn't any experience around that. How do you handle that? But commercial banking's alive, going to do very well. And I think people are getting back in the habit now of having to manage and optimize a balance sheet and produce an income statement from that. Relationship banking ties into that. I don't think 2020 March 23 was indictment of banking. It was some people were executing a model which the markets had rewarded them for quite well, but the model became outdated very quickly, and they didn't know that. I don't know why they didn't know that, but they didn't, and they got caught. But banking in general I think it's very resilient. There's going to be consolidation at sorts. We've been doing it for a long time. There will be someone continue to do that. There will be continued growth. It's going to be successful. But that idea that you have to actually manage your bank on both sides of the balance sheet is something that was not around for a while.
Yeah. Now, how critical is profitability assessment of relationships in today's market?
Oh, I'm biased because that's one of the things we do. So, but I'm just warning everyone on that. first start with relation. There are two models in banking in general. One's a transactional model where people sell products and services. And they do it on a product by product basis. Another one's more of a relationship model. Most banks talk about they're in a relationship model, that we're going to build relationships and we're going to, that's what we're into, and we're going to take care of them and whatnot. Most banks say that. Most banks in reality are in a transaction model. They think about a new loan, a new deposit, and these kinds of things. Long term, I think the overall success can be in a relationship model if you can execute that well. Part of a relationship, I'll give you a simple example of a relationship model. Generally speaking, banks, if you grouped up all the banks, put them into relationships. So you took all this, in consumer, you built a household, and then commercial, you took all the tax entities and you rolled them up to one entity. If you were to ask what percentage of your clients do you have the primary operating account for that relationship, unfortunately, that answer is somewhere between 40 and 60%. Most banks don't even have, it's really in that range, freaks everyone out when they see it. Some people are higher than that. Some people aren't quite as good as that. But if I were to tell you that you're the only, because if you have the primary operating accounts, generally when your client would say, that's my bank, you're probably this, if you think about the inverse of that 40, 60 to 40% of your customers, you're in a secondary relationship with. Their primary is someone else. And they don't know that. So that's one thing. Understanding the profitability around that. Let's go with commercial because it's easier because of some of the laws. In commercial, how do you know where to price? There's market price, which is set by the market. You don't control that. But how do you know what's the right thing for your balance sheet strategy, for what you're trying to do, unless you understand how that relationship is performing from a shareholder value, right? The client is getting client value from all the services and things you provide, capital, liquidity, all that. The shareholder is getting a return on that. And if you don't understand that by client, how do you make sure both the client and the shareholder are winning? And when you execute that, that's at a client level. That's, consumer's a little different. Consumer, you do more at pool levels. But in commercial, you want to make sure that both parties are winning. Because if you do, you're going to have a long-term relationship. If the bank's winning massively and the client's not, you're going to lose the client because someone else is going to take them. If the client's winning massively and your shareholder's losing, that's not going to be good for you in the long run. I don't know if that helps, but understanding that profitability on a capital, who's using your liquidity and capital, and are you getting paid for it? From a shareholder return is the question you should ask.
Yeah. And how important is it as well as getting color around on the wealth side? Like for example, but maybe I'm a strange situation, but all my businesses, I tend to use Bank of America. But then on my personal side, I use 3 banks, but then most of my cash is sitting in my brokerage account with Charles Schwab.
Yep.
Like how's that all going to need to interconnect to really truly understand the relationship?
Let's take it into like 2 parts. Let's just say inside your organization, because lots of banks have wealth parts, right? Some of the larger ones you just mentioned do. This is a real life story. I mean, this happened to someone I know. They were a doctor running a practice, had a fraud issue. Practice has, let's make believe, $250,000 in cash there. Wealth-wise, she's got, let's say it's 20 million, right? Sitting over in wealth. The people this is a very large bank, did this, won't mention who it was. The people that were the fraud issue put a hold on all of their accounts for about a month. They thought it might be a fraud issue. It might be she was fraud issue or whatever. They didn't know there's $20 million sitting over here, even after she told them. And she, of course, pulls everything and she's somewhere else now. And you essentially had a bad customer service experience that also turned into this. So first thing is understanding what they have with you across your silos is critical. That's just inside the bank. If you have those operating accounts, you can actually understand where they're transacting outside. So if your Bank of America was I don't know if it is or not, but is a primary account, it can see you interacting with Schwab and Wealth and all these other things. And you can put together an understanding of how this customer is working. You probably prefer, I don't know if you do or not, but you probably prefer having multiple because it allows you to balance things from a different perspective. Most consumers would probably, not probably us, but most, or bankers even, would probably prefer to have everything because it's easier in their lives to have it all put together. But you can need first to understand what's going on inside your bank, then understand where they're interacting across their relationships with other entities. Some things you'll be able to offer them better value. Others might be they get better value there, and that's just the way it is.
No, that's very insightful. Thank you, Mac. So, you know, really, really appreciate you being on today. You know, the last segment of the show, it's really a way for you to connect with the community
Yeah.
and the listeners. It's really about, you know, what type of people you want to connect with, and also how can they help you? Because look, what White Clay does is quite amazing, right? You solve this challenge. So I'll give you a few minutes to talk about that.
Oh, all right. What we do from logistics operational perspectives, we take every account, every transaction across every system in a bank, put it all together, build the relationship across those disparate systems. So internally, when you're looking at a client, you can see everything. We add profitability at account client level, risk and capital adjusted. We add transaction behavior, deepening behavior, tie it all into incentive, everything you want to know about that. The real trick, we deliver all that directly to the bankers and the management teams in the field. The real thing that we do though is the environment's very configurable and can align to the organization's strategy, because what every bank wants to do isn't identical. Some aspects are very similar, but they're not. One bank may choose to want to grow this way or that way. What we can do is align the strategies that you have coming out of ALCO or your executive team or your board meeting where you want to go, and directly give you line of sight to the behaviors bankers are doing to help the bankers make the right decisions and deliver the right behaviors to deliver the organization to where it wants to go. That connectivity from the banker level, either a branch banker, business banker, commercial banker, specialty, wealth, is really what we focus on. And we help align. So we do the software piece, but we also help the bank align where they want to go with how that software is modifying, coaching, inspecting, all that banker behavior. So it's information turned into, data turned into information, turned into knowledge, delivered as wisdom that's really reinforced by encouraging the right behavior. Because until a banker changes their behavior, you're really not going to get a change. That's what we do. And we manage and curate those environments from banks to 600 million up to 200 billion. And it's awesome. We have a great relationship with our clients and love everyone. So that's what we do.
No, and it's a fantastic platform. I had a demo on it a month or two ago, and it was like amazing. Like everyone should know about you. Everyone should understand what you and your team are doing, because it's amazing work. So Mac, thank you for being on today. But to the audience, thank you for your continued support. Look, if you're listening, you're in commercial banking, please reach out to Mac, and have a great weekend, everybody. Thank you, Mac. Thank you, everybody. Bye-bye.